A very good morning to all of you students. Today we will continue with the topic of derivatives. So let's start with the question number 17. And till the previous sessions we have completed till question number 16. These are from the assignments. Suman wanted to buy shares of EIL which has a range of rupees 411 to rupees 592 a month later. The present price per share is rupees 421. Her broker informs her that the price of this share can soar up to rupees 522 within a month or so that she should buy a 1 month call of EIL. So if you see, the expectation is that the price will go up. The current price is how much? 421. So if the expectation is that the price will go up, in terms of options, you will buy a call option. That's what the broker is also suggesting to Suman. In order to be prudent in buying the call, the share price should be more than or at least 522, the assurance of which could not be given by her broker. Now, ultimately, if she buys the 1 month call option at 522, then the real price, the spot price has to be higher than 522, right? So for that, the assurance is not given by her broker. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price of rupees 592 so that buying a 1 month call of EIL at the execution price of rupees 522 is justified. So now what the question is asking us to calculate is the probability. Probability of what? Probability of attaining the share price of 592. Advisor take the risk-free rate of interest to be 3.6% and e raised to the power 0.036 is equal to given to us. Clear, students? Now, from our previous understanding, so there are two ways to calculate a probability, right? One is the risk neutral method and one was under the binomial method. And both the methods I said will give you the same result because one method is derived from the another method. But in this case, it's a continuous compounding that is given in the question. So instead of 1 plus r in the formula, it will become e raised to the power r. Clear? Now, if we see, the question itself has specified us two different ranges. Sorry, a single range with a higher range of 592 and a lower range of 411. Okay. Now, the current spot price as on today is how much? 421. So this is the expectation after 1 month. After 1 month, it is expected that it might go up or it might go down. So the 1 month, so we are talking about 1 month call option with a strike price of 522. Okay. Now, the point to understand here is that in binomial model also there are two different possibilities, one higher and one lower. The same case is with this question as well. So if it goes downward, so then it will be 411 and the current price is how much? 421. So this becomes the proportion of share price going down. For upward, it will be 592 divided by 421. Again, this is the proportion of share price going up. Now the probability that price would be 592 B P bracket U, right? Probability of price going upward, and hence PU is equal to e raised to the power RT minus D divided by U minus D. This was the formula. Good morning, Ojajini. So instead of 1 plus R, we have substituted it with e raised to the power RT. Clear? So probability of price going up, which is 592, becomes e raised to the power 0.036 minus the proportion of price going down is 411 divided by 421 whole divided by 592 divided by 421 minus 411 divided by 421. So it translates, the formula above translates into this value. Okay. And hence e raised to the power 0.036 becomes, or rather it is given in the question, 1.037 minus 0.976 divided by 1.406 minus 0.976. So this becomes 0.1418, which is actually 14.18 percentage. Clear, students? Any question, any doubt in this? It was a very easy question. It just asked us to calculate the probability, that's all, for a 592 rupees price. And using our knowledge on the binomial model and risk neutral method, we have calculated the probability. Okay. Now, let's say this is the formal solution till here, but just to understand, probability that the price will move to 592 after 1 month is 14.18 percentage. So 421. So there are two possibilities, right? 421 going up to 592, and hence a probability of 14.18%. And the second one is the price going down to 411, and hence the probability of 85.82%. And the 522 price will rest here in between. Sorry, yeah. it will rest somewhere in between at this level. Clear? So the probability of price going down is more. Correct? Hence the call should be taken accordingly by Suman. Clear? Any questions, students, till now? Please do let me know. Let's move to question number 18. Consider a 2-year call option with a strike price of rupees 50 on a stock the current price of which is also rupees 50. Okay, the strike price is also 50 and the current price is also 50. And the time period of this call option is 2 years. Assume that there are two time periods of 1 year, and in each year the stock price can move up or down by equal percentage of 20%. Okay, so it is saying that it can either go up or down. If it goes up, it will go up by 20%. If it goes down, it will go down by 20%. The risk-free interest rate is 6%. Use binomial option model. Calculate the probability of price moving up and down. So first is how the probability will be calculated. That's very easy. Also draw a two-step binomial tree showing prices and payoffs at each node. Node means at every interval, right? So for every interval, the payoffs needs to be calculated and the prices also needs to be determined. Okay. So let's talk about the 2-year call option. So the strike price is equal to 50 and the current price is also equal to 50. That's the first information that is given to us. So there are two intervals 0 to 1 and 1 to 2, right? So for 2 years there will be two intervals 0 to 1 year and 1 to 2 year, correct? And in both the intervals either the price can go up or go down. So let's first of all draw a tree. A tree means nothing but the similar format that we have been discussing till now. So let's say A is the starting point, which is as on today. So after 1 year, the price is 50 here, right? So after 1 year, the prices can move up, right? Which is given by B, clear? So it can move up by how much? 20%, 20% of 50 rupees. So if we add 20% of on 50, it will become 60. Clear? And the second option or the second possibility is that the prices will go down. So 50 rupees going down will become at C node 40. If I just name this as a C node, okay? This is a C node. Now, again, this 60 has two chances. So this is year one. If I may say, this is year one. Now, from year one to year two, can anyone tell me how much 60 can become? What are the two different values? Let's name it as D. Let's name it as E. Similarly, C will also become to two different parts. Yes, students. Tell me how much 60 can become from year 1 to year 2.
72.
Yes, 72 on a higher value.
48.
And the yes, very good. The next one will be 48. Now, similarly, 40 also have two chances, right? 20% higher on 40 is 48. So C And so B's lower value and C's higher value, both of them will result into 48. So I've taken that as E. And then C, which is 40 rupees, can also go down by 20%. So it will become 32. Clear? So this is the tree that question was asking us to prepare, right? So this is the starting point. So we have plotted the movements of the prices as per the facts that are given in the question. Now the probability of prices going up by 20% is equal to 1 plus R, which is 1 plus 6% minus the downward proportion, which is 40 by 50 divided by 60 divided by 50, which is the upward proportion minus 40 divided by 50, which is the downward proportion again. Okay. So D will become what? 0.80 and U will become 1.20. Clear? So 20% added to 1 is 1.2, 20% reduced from 1 of 1 will be 0.8. Clear? So probability of prices going up will be 1.06 minus 0.80 divided by 1.20 minus 0.80, which is actually 65%. Probability of increase in price is equal to 65%, and the probability of decrease in prices is actually 35%. Clear? So both the probabilities we have calculated, students, the probability of going up and down. And anyways, to calculate the payoffs, we need to calculate the probabilities, because then only at each node we can calculate the payoffs. Clear? Now, if I may tell you, always start from here to here while you calculate the payoffs. Okay, so always start from the last time period to the first time period. The reason is the payoff at B's node will be an outcome of what D and E is offering in terms of the payout. Okay, what D and E is giving you will actually result in what B is supposed to give. Okay, so hence, if we want to calculate the payoffs, so we'll write that calculation of payoffs at each node. Nodes are D, E, and F. Expected price is 72, 48, and 32. 72, 48, and 32. This is basis the numbers that we have plotted. The strike price. So students, how are we going to calculate the payoffs? We are just going to compare the expected price with the strike price. And if the question is on the call option, which I think yes, the question is Yes, 2-year call option. So hence, if the expected price is higher than the strike price, then there will be a payoff. 50, 50, and 50. Value of the call option becomes 72 minus 50, which is actually 22, right? The higher expected price beyond the strike price becomes the value of call option. Now, the second one, which is 48 minus 50, shall I write minus 2?
No, sir. Strike price is greater than the expected price.
Yes. So in that case, the payoff will be 0 because it's an option. Had it been forward, then we would have mentioned minus 2. But since this is an option, the lower expected price will not result into a loss to the option holder. And if I may say, remarks, it is in the money, this is out of the money, and this is also out of the money. Clear? So these are the three value of call options, or let's say the payoffs at the end of the second year. Now, if I may say, for B node, so B node is comprising of what and what? B node is comprising of D and E students. D and E. So what is the payoff at D? 22. What is the payoff at E? 0. Right? And what is the probability that D will prevail? 65%, right? The probability of price going up is 65%, and the probability of price going down is 35%. So at B, first of all, we will calculate the expected value. So the expected value will be calculated as 22 into 65% plus 0 into 35%. And this is a value after the second year end. We have to calculate the value at the first year end. So we will be doing 1.06 to make it at a present value level. So at B, the value becomes 13.49. Clear? Then at C, there are two different possibilities, E and this is F. Okay, E and F. So both E and F are having zero payout. So 0 into 65% plus 0 into 35% divided by 1.06. So this becomes 0. So B becomes 13.49, C becomes 0. Now accordingly A will be the weighted average of B and C. It will be 13.49 into 65% plus 0 into 35% divided by 1.06. Accordingly, it becomes 8.272. So the value at A becomes 8.27. And if we can present it in this manner also, it will be good. So this is the A, this is B node, and then this is C node, Yeah, sorry. So let me repeat. I think there was some issue. So the value till A node was calculated as this. What I'm presenting below is a better presentation of the payoffs, right? So I'm just redrawing the tree, and accordingly then we will put the values at the different nodes. Okay. Then the C becomes, C also has two options, E and F. Clear? Now the value at these different nodes, I'm just presenting it with a different color. So it is 22 rupees. At E it was 0. At F also it was 0. At B it was 13.49. At C it was 0. At A it became 8.272. And if I may just tell you that this 8.272 that we have calculated is actually the value of the option. This becomes the value of the option because this is the bare minimum expected by the option writer. Because option writer will say that basis all the probabilities and the binomial model, I will end up paying this much. So at least this much I am expecting as a premium. Okay. I hope this is clear, students. Sorry. Yes. So this was the question. Okay. Now, if I may say, for binomial model, it is used in both the different types of options. Can anyone tell me what was the difference between American option and European option?
American option can be exercised till the exercise date, whereas European options can be exercised as on a particular date.
Perfect. Yes. So American options gives you an option to exercise the option up to a expiry date. So anytime you feel the option is exercisable, the option is favorable to you, you can exercise it. But the European option can only be exercised at a given point of time. So this binomial model is actually useful for calculating the value of an option in both the circumstances. Why? Because American option, you will assume that the increase or decrease is expected every moment. Okay. And accordingly, we can calculate the probability and the present value of such payoffs, just the way we calculated in the above question. Okay, so let's say it will have multiple increase decreases attached to it. I'm just denoting it so that it's clear. Okay, so it will have multiple increase decrease. Okay, but European will only have one increase or decrease over the period of time. This is linked to the expiry period. Okay, let's move to question number 19. The current market price of an equity share of Pension Limited is rupees 420. Within a period of 3 months, the maximum and minimum price of it is expected to be rupees 500 and 400 respectively. If the risk-free rate of interest be at 8% per annum, what should be the value of a 3 months call option under the risk neutral method at the strike rate of rupees 450? And we have been given a e raised to the power 0.02 as well. Now, students, if you see, this question is a very simple question. So, under this question, we are finally required to calculate a value of the call option, right? The value of the call option means the premium of an option. Again, the premium of an option will mean whatever expected payout the option writer will expect, at least that much premium the writer will expect. Clear? So this is again a question on risk neutral method. Let's plot all the numbers that are given to us. What is the current spot price? 420. Time period is actually 3 months. The maximum price is actually 500 and the minimum price is actually 400. If the risk-free rate of interest is equal to 8% per annum, what should be the value of 3 months call option under the risk neutral method? And the strike price is actually 450. So tell me, students, where are we going to use the strike price? Where are we going to use the strike price to calculate the payoffs? And while we will calculate the payoffs, using those payoffs, we will calculate the value of the call option. Clear? And please remember, this is a question on call option, not on put option. If the question specifies a put option, then the calculation will exactly reverse. Okay? In terms of calculating the payoffs. Probability of price going up B, X, price going down B, 1 minus X. Clear? If price going up is X, going down will be the 1 minus X. The current spot price, which is equal to 420, we are applying the risk neutral method formula, right? So the current price is 420. The higher price is 500 into X percentage. I'm just keeping for denoting the probability, plus 400 is the price going down, and 1 minus X percentage is the probability of the price going down, divided by the present value factor. Now here also e raised to the power is given, which we will make use of it. So that means it's a continuously compounded rate. So e raised to the power 0.08 is per annum rate for 3 months. That means 3 by 12. Clear, students? This is the same formula that we have studied in the risk neutral method. So 420 into e raised to the power 0.02 is equal to 500x plus 400 minus 400x. This is the future value, right? And this is also a future value. Correct? Because 420 is today's spot price. I'm multiplying the future value factor. So in a way, we have equated future value to future value. Okay, so this becomes 420 multiplied by e raised to the power 0.02 is 1.0202. This becomes 100x plus 400, right? And if we solve for this, the x will be 28.48 percentage. So now if we say probability that price would be 500 becomes 28.48 percentage, and probability that price would be 400 becomes 71.52 percentage. Clear? So both the probabilities we have calculated of the prices going up and down. The current price, which is 420, let's say this is the A node, this becomes B node, this becomes C node. So at B node, higher price 500 with a probability of 28.48 percentage. At C node, lower price of 400 with a probability of 71.52. Clear? So let's calculate the payoffs at each nodes. First of all, let's start with B and C. The expected price is actually 500 and 400. The strike price is actually 450 and 450 in both the cases. So the payoffs at B node will be 50 rupees because it's a call option and the accepted price is higher than the strike price. At C, it will become 0. And then there will be a probability 28.48 percentage, 71.52 percentage. Clear? And lastly, we will put probability into weight. This will become 14.24 and nil. 14.24 becomes the weighted average payoff at both node B and node C put together. Now, if we have to calculate the value of call option, which is the payoff at A node, right? So at A node, it will be 14.24 divided by e raised to the power r into t, which is actually 14.24 divided by e raised to the power 0.02. This is actually 14.24 divided by 1.0202. So the value of call option will be 13.96. So what call holder and call writer will say? Call holder will say that I will pay maximum up to 13.96. Call writer will say that I will expect minimum of 13.96 as the premium. Correct? Because call writer will say that at least this much I'm going to incur as a payoff. Call holder will say that maximum I will be able to pay this much because this is the amount that is expected to be paid to me. So 13.96 actually becomes the theoretical minimum price, students. Correct? Similarly, in case of options that we understood, right? So the same nomenclature also fits in here. So at this price, the arbitrage is not possible. So that's why we call it as a theoretical minimum price. Clear? Okay, so let's move ahead now. Yeah. So let's come to some of the interesting part now. Okay. So for options, students, let's discuss some of the different situations. So case one, I will put four different cases, students, okay, and we will be using those four different cases into some or the other situations, okay. So the case one is long call option. If I am longing a call option, that means I am purchasing a call option. I am purchasing a right to buy. If I'm purchasing a right to buy and if I have to execute it at the time of expiry, I will have to pay the strike price equivalent value to purchase the share. Correct? So, what I should do today, right to buy, is what I've got. But in case I am longing a call option, I've purchased a right to buy. Immediately, I have to invest the present value of strike price. I have to invest the present value of strike price. On expiry, I will get the strike price equivalent value, correct? And that strike price equivalent value I will use to execute the call option. Clear? So this is one of the case. Now, if I am, so I'm saying if I do something in the option side, what I have to do on the another side, whether it is on the funds side or whether it is on the spot market side. Okay. Now, if I'm doing a short call option, I hope all of you understand short call option means we are writing a call option. We are
Mhm.
selling a call option. Again, what we are doing in call option, we are selling a right to buy. Now, can anyone tell me if tomorrow the option is exercised? what action will happen, and to complete that action, what should I do today if I have done a short call option today.
I will have to sell the at strike price. That's why I will get money in future.
I will get money in future, but what should I do today so that the contract gets executed?
Borrow.
No, why to borrow? I'm saying, okay, in a way, you are right, but the intermediate step will be to purchase a share today. Purchase a share today. Reason being, if you purchase a share today and tomorrow the option is exercised, you will give that share to the option holder and hence your option will get exercised. For purchasing this share, yes, you will have to borrow. Okay. Then the third case. The third case is long of put option. Put option is what? Right to sell. So if I have purchased a right to sell, what should I do today? So that tomorrow, if I want to exercise the right to sell, I can
Purchase
execute that
today.
option. Sorry?
Purchase today.
Yes, I have to purchase a share today. Okay. And last case, I have to short the put option, right? This is the last case left. For call option, I have given the situation of purchasing and selling. Similarly, for put option, purchasing and selling. So this also is the right to sell. I'm selling the right to sell. If I'm selling the right to sell and tomorrow the option gets exercised, then I have to purchase the share. If I have to purchase the share as on the date of expiry, I will have to invest the present value of money today, present value of strike price today. Invest. I hope these four different situations are clear. So two of them I will be using in the Black-Scholes model, which we will discuss today, and two of them we will be using in the put-call parity theory. Okay, that also we will discuss maybe in today's session or in the next session, depending on the time. Okay, so why these four cases are important? Just to draw the parallels, how the situation moves with whatever position you are holding in whichever yeah. So what I was saying is that we will be using these four cases in the subsequent discussion. Two of them will be used in Black-Scholes model and two of them will be used in the put-call parity theory, students. Okay. Now always remember this line which I am just writing. Options premium is always reflective of the extent to which it is in the money adjusted for time value of money. So just try to remember this layman language. Basis this, you will be able to derive the value. So what we are saying is options premium is always reflective. I'm not saying that it is always equal. We are not saying that it is always equal. I'm what we are saying, it is always reflective. If the extent to which in the money it goes up, the value of the option will also go up, right? So it always is reflective of the extent to which this option, it is means the option is in the money, right? Now with this, what I'm trying to say is that if the option is out of the money, then the option premium will become zero, because option premium is always dependent whether the option is in the money, at the money, or out of the money. See, you only think if the option is out of the money, then do you think the person who is going to purchase that option will pay any amount for that option? No, right? Because just a second, students, let me switch my network. I think there are some issues again. Yes. I hope this is fine now, right? Am I audible and visible? Both? Okay, perfect. So let's continue. Yeah. So what I was saying is, I was just trying to explain this line item. The option premium is always reflective of the extent to which it is in the money. So imagine if an option is out of the money, no one will be willing to give any value or any premium for that option. If the option is in the money, the option writer will expect at least that much amount to be received as premium, right? And why I'm saying adjusted for time value of money, because the settlement of an option might happen 3 months, 6 months, 1 year from now, whatever is the time period. And premium we are calculating today. So today's value has to be computed as the present value of what that option holds as in the money for future. So you remember in the binomial model also, we did the same thing. While we calculated the option value at node A, we assumed whatever is the payout happening on node BC will be taken into the present value, and hence the value of the option got calculated at A. No. Okay. So let's do one question. Question number 20th. Okay. AB Limited's equity share are presently selling at a price of rupees 500 each. An investor is interested in purchasing AB Limited's shares. The investor expects that there is a 70% chance that the price will go up to rupees 650 or a 30% chance that it will go down to rupees 450. So even they have given us the probabilities also along with the two different possibilities of price going up and down. There is a call option on the shares of the firm that can be exercised only at the end of 3 months. That means it's an European option at an exercise price of rupees 550. Now calculate the following. If investor wants a perfect hedge, what is the combination of share and option should he select? Right? So they're asking us to calculate the combination of the share and option. Explain how the investor will be able to maintain identical position regardless of the share price. That means a complete hedge. The second part is also asking us to calculate the complete hedge. If the risk-free rate of return is 5% for the 3 months period, what is the value of the option at the beginning of the period? And lastly, what is the expected return on the option? Okay. So these 3-4 things they are asking us to calculate. Let's just first put down all the facts that are given. If it increases, so there is a probability of 70% that the price will increase and it will increase up to 650. If it will decrease, there is a probability of around 30% and the price is around 450. Time period is for 3 months. Strike price is how much? Is 550. So if the investor is interested in purchasing the AB Limited's shares, okay, now comes the catch here. If the investor is interested in purchasing the equity shares, what action the investor should do in options market, whether should buy a call option or sell a call option? Come on, students, tell me.
Sell a call option.
Okay. Any other views? I'm not saying that in I'm not saying that the investor has already purchased. I'm saying that the investor is interested in purchasing the shares because he's
Then it will be
that the
buy call.
yes. So the investor is saying that in future, or let's say speculating that the prices might go up and hence he might buy the shares. So buying the shares is equal to buying a call option. I'm not saying equal in the sense of commercial aspect, but in the sense of the risk of upside or downside, right? Just a second, let me. An investor is interested in purchasing AB Limited shares. The investor expects that there is a 70% chance this is okay. There is a call option on the shares of the firm that can be exercised only at the end of 3 months once a perfect hedge. What combination of shares? Okay, I think I misinterpreted this. The question is directing us that the investor wants to have both share and option both, right? So this will change our strategy here. I think the first answer was right. Who has given the first answer? That was right, which is selling the call option. This is right. Why? Because the question is saying that the perfect hedge is required and both shares and options should be selected. And in the above part, question has specified that purchasing the shares is what investor wants. Clear? So we are saying if we purchase the shares, equity shares in spot market, then we will be selling the call option in the options market. So finally, our strategy will be long shares and short call options. Okay. Now let's talk about the perfect hedge. The first part is talking about perfect hedge, right? So the perfect hedge is, let's first calculate what's the range of the payoffs. Okay. Payoff if price goes up at 650. So this will become 650 minus 550, right? Which is actually 100. So 550 is the strike price, 650 is the expected price, and hence the payoff will become 100. Payoff if price goes down at, what was the price? 450, right? So 450 minus 550 becomes nil. Nothing will become paid or payable because of the option. So another term to call this a hedge relationship, I mean the combination of shares and options to achieve a hedge, is called as the hedge ratio. So hedge ratio will tell you for how many shares, how many options needs to be sold. So for how many shares purchased, how many options needs to be sold. Okay. So this will be given by 100 minus 0, which is the payoffs at higher and lower value, divided by the higher and lower value itself, which is 100 divided by 200. So just remember this formula. So this hedge ratio in this specific situation is calculated like this. There is a different way the hedge ratio is calculated in a Black-Scholes model that we will discuss later on. Okay. So the perfect hedge will be achieved as what? I'm just rewriting the formula here. Payoff at higher price minus payoff at lower price, whole divided by higher price minus lower price. Okay. So in a nutshell, it will say 0.50 shares to be purchased for one call option to be written. So if I'm selling one call option, against that one call option, zero point 0.5 shares needs to be in place. So the first part is clear, students. So this is the perfect hedge. For zero point 0.5 shares, one call option can be written. Now the second part, it is asking us explain how the investor will be able to maintain identical position regardless of the share price. So this we can prove, right? So basically question is saying that first you determine the hedge ratio that we have done 0.5 is to 1. Now the question is saying if we go ahead with the hedge ratio of 0.5 is to 1, then how the investor will be able to maintain the identical position regardless of the share price. So what we will do, we will first prove it with the higher share price, then we will assume a lower share price, and then accordingly we will give the conclusion. Okay, so A part, if the price on expiry is 650, then so two things will happen, right? One is the sale proceeds of the shares will happen, correct? How many shares we have purchased? Zero point 0.5 at the rate of 650. 325 will be realized from the shares minus loss on call option. Here the loss will happen of 100 rupees. Why? Because 650 is the expected price, 550 was the strike price, and we are the option writers. Being option writer, there will be a loss if the share price is higher than the strike price in case of call option. So 225 becomes the net cash inflow. Okay. Clear? Then on the B part, if the price on expiry is 450, then sale proceeds will be equal to 225, which is how we have calculated 0.50 into 450. Clear? And what will be the loss on call option? It will become nil, right? Because 450 minus 550 is nothing to be paid. So in totality, it will become 225 again. Yeah. So 225 here and 225 here. So if it's a complete hedge, then only the situation is possible, where in both the cases, 225 and 225 is the price. at price 650 as well as 450, the net cash inflow on expiry remains same. Hence, this is a complete hedge. Clear, students? Any questions or any doubts till now, please do let me know. Then we have the third part, students. The third part of the question says, if the risk-free rate of return is 5% for the 3 month period, 5% is for 3 months period, what is the value of option at the beginning of the period? Okay. Now, we have to calculate the value of the option. Let the value of option be P, right? We have been given all the information and accordingly we'll have to calculate the value of option. Now, if I may say that whatever is the price, 225 is the value, right? 225 is the net cash flow at happening at the maturity period. So if I take a present value of it, right? If I take a present value of that net cash flow and equate it to the current strategy. What is the current strategy? Purchasing a zero point 0.5 share and short selling a one call option. What is the current price at which I would have purchased? 500 is the spot price, right? So in the question it is mentioned 500 is the spot price. Clear? So what I will do, 500 spot price into 0.50. This becomes my original cash outflow for purchasing zero point 0.5 shares. And if I write a call option, I will receive premium or I will have to pay premium.
Sir, receive
I will
premium.
receive premium,
Receive.
yes. If I receive premium, so for one share, I will receive P, right? Which is what we have assumed to be. And this is minus, right? Because this is outflow and this is inflow. Clear? So this is my net cash flow and 225 divided by 1 plus R is also my net cash flow on expiry. Clear? So yeah, I have equated the present value of 225. Clear? So this is the way of calculating option in this given facts. So this is 250 minus P is equal to 225 1 plus 5%. 5% is R, that is already given in the question. So this becomes 250 minus P is equal to 214.2857, and hence P becomes 35.71. The value of call option, which we call as premium, is equal to 35.71. I hope this is clear till now. No, Sahil, I don't do trading. Any other questions, students? Yeah. So let's move to the last part of this question. What is the expected return on the option? What is the expected return on the option? Now, for calculating the expected return on option, students, first of all, we need to understand that what is the investment value in the option. See, return you will calculate on an investment. For that, you need to know what is the investment value. Can anyone guess or can anyone tell me what should be the investment value of an option? Guess, students, tell me what should be the investment value of an option on which I should calculate the expected return.
The premium we pay.
Yes, very good. So the premium is actually the price we pay for purchasing or selling a option. So that becomes my investment value, right? And the return on that will be if I invested 35.71 rupees today, and later on after 3 months I'm getting some other amount. So that extra amount I'm getting over and above 35.7 is the return. Okay, that's the interpretation of expected return. So for that, we need to calculate that what are the expected payoffs. So the expected payoffs are actually 70% of the chance that it will be 100, and 0% and 0 rupees will be 30% chance. Correct? Why I'm saying 0 rupees? Because in the second case of 450, the payout will become 0. So it becomes 70 plus 0 is equal to 70. So 70 is the most likely outcome on the payoffs, expected payoffs after 3 months, right? And one more thing, students, here we need not consider the zero point 0.5 short selling of the options because that is not important here. Here we are only calculating the expected return on the standalone call option. Okay. So I am going to invest 35.71. Against that, the most likely expectation is that I will get 70 rupees. So the expected return becomes how much? 70 minus 35.71. So hence the incremental amount is 34.29. So this becomes 34.29. and hence the expected return will become in terms of percentage also we have to calculate, because generally return is expressed in the form of percentage, right? So 34.29 divided by 35.71 to 100, which is equal to 96.02 percentage. Clear, students? So this expected return part is clear to all of you. So I think with this we complete the question number 20th. Okay. So now after question number 20, so one more question is left on this topic, 21st, and after that we will start the Black-Scholes model, students. Before that, let's take a break for 10 minutes. So it's 8:20 right now. Let's reconvene at 8:30. Let's move to the next question. Question number 21. Yeah. So a 2-year tree for a share of stock in ABC Limited is as follows. 100 rupees is on N1 and then N2, N3 nodes is having 108 and 95. And after 2 years later, again 108 goes up and down, and at N3, which is 95, also goes up and down. Consider a 2 years American call option on the stock of ABC Limited with a strike price of rupees 98. The current price of the stock is rupees 100. Risk-free rate, risk-free return is 5% per annum with a continuous compounding, and e raised to the power 0.05 is equal to this much. This is also given on a straightaway manner. Assuming two time periods of 1 year each, so the first year and second year, only two time periods. Using the binomial model, calculate the probability of price moving up and down, expected payoffs at nodes N1, N2, N3, round off up to 2 decimal points. Clear? A very similar question we did earlier, right? So solution. Calculation of probability. Probability of price going up becomes R minus D divided by U minus D. This is a question on continuous compounding. So we can put e raised to the power 0.05 minus 95 divided by 100. This is the proportion of the prices going down, which is 95 at N3. And the proportion of price going up is 108, right? Minus 95 divided by 100. So probability of price going up becomes 1.05127 minus 0.95 divided by 1.08 minus 0.95. So this becomes 77.9 percentage, or we can say 78 percentage. So if the probability of price going up is 78, the possibility of price going down, the probability of price going down becomes 22%, students. Okay, so this was the first part. The second part, expected payoffs at each node. So to calculate the expected payoffs at each node, we need to first understand that what will be the payoffs at this node, and this node, these three nodes, right? These are not given any specific node names. So let's calculate the direct payoff of N2. Calculation of expected payoffs. N2 is equal to 116.64, right? So let's start from the top. So the after 2 years, the highest value that can reach is 116.64. What is the strike price? 98 minus 98. Percentage of prices going up is 78%. That's the probability, right? Plus the second downfall is 102.60. Still it is higher than 98. So there will be a payout, correct? So at this node, both the prices will have payout. This we are talking about N2 specifically, right? N2 is broken down into two things, 116.64 and 102.6. This whole divided by the present value factor. So the value at N2 becomes 14.79. Clear, students? Then similarly for N3. This is very similar question that we have done earlier, right? So at N3, the higher price is 102.60. At this price, there will be a payout into 78% plus. At the lowest price of 90.25, there will be no payout into 22%. Whole divided by 1.05127. So N3 will become 3.41. Right, at N3 the payoff will become this much, and then finally at node 1, 14.79 into 78%, which is the probability, and 3.41 multiplied by 22%, which is again the other probability, divided by 1.05127. So N1 becomes 11.69. Clear? So at all the three nodes, we have calculated the payoffs. Okay, N2, N3, and then finally N1. Clear? Any questions till now, students? Please do let me know. Otherwise, let's move to Black-Scholes model. Okay, so let's move ahead. Yeah, no other questions? Perfect. So under options pricing, this is the another method. So first method we discussed about the binomial model. Under binomial model, we discussed about calculating the probabilities as two different manner, right? Risk neutral and other way. Now this is the very important method how to calculate an option pricing. So let's make use of case number 2, right? The four cases that we have written today in the first half, I am using case number 2 from that. So let's assume that there is Mr. X, okay, and Mr. X have purchased the shares. Simultaneously, in case 2, we discussed, right, shares being purchased, so there has to be a writing the call option. So selling right to buy. Just a second, let me just right to buy. Clear? or we can say this is right call option. Okay, this is the A part and this is the B part. These were the two strategies, right? For writing a call option, we need to purchase a share. This will lead to cash outflow today, right? And here the cash inflow will be the present, will be the strike price, right? If the option gets exercised. Correct. If I'm saying the settlement is happening on a gross to gross basis, so the purchased shares will be purchased today, which are purchased today. For that, we will do the cash outflow today. And under this option that we have sold, we will sell the shares and realize the strike price. Correct. So cash inflow will be strike price. Let's assume this to be 100, the cash outflow today. That means the spot price is 100. And let's assume this to be the 90. Correct. So if I say that the strike price is 90 and the spot price is 100, I'm just referring not these as a specific values. I mean, this 190 is okay to understand the terminology here. But I'm saying that ultimately, if you're writing a call option, you understand it from the point of view of Mr. X, right? If you are Mr. X and you have these two things, what premium you will charge? You will say that whatever is my outflow and whatever will be my inflow, that's what I am going to charge the premium. Now here 100 rupees is my outflow minus 90 rupees is going to be my inflow. So net net I will be falling short of 10 rupees, right? Because I have paid 100 rupees, I have realized 90 rupees. So I should charge this amount, this I have lost as premium. I'm not saying 10 rupees is the premium, but I'm saying the way it will work is Mr. X will plot his cash outflows, Mr. X will also plot his cash inflows and accordingly see what is the shortfall in the earnings. So can I say that A minus B is equal to premium? What is this A and B? A is the share purchased situation, B is the selling of the right to buy. If I have to explain like this, then A is equal to cash outflow today, right? And B will be, let's say, after 3 months, the cash inflow. Equal to strike price. Correct? This is how it will happen. So principally, do you all agree that A minus B is equal to the premium? Now let's correct this formula. How we will correct this formula?
Present
Since
value.
very good. So A is the today's value and B is after 3 months value. We will just take B to the present value first. So A minus present value of B becomes premium. Correct? Now these values are more comparable because A is today's value and present value of B is also today's value. I'm just rewriting this as premium is equal to A minus present value of B. This is fine. Now let's talk about call option first. right? Because the case 2 we have taken for call option. So premium for call option is equal to spot price. A was what? Spot price, right? A is the situation where you are purchasing the shares. Purchasing the shares will happen at spot price minus present value of B is what? Strike price. So this is the formula. Are you with me till now, students? Please let me know. So the premium for call option, if I rewrite it, it becomes spot price minus present value of strike price. Now here we have made one more mistake. We will correct that mistake in the next step. Hence, we will derive the formula. What mistake we are making here is we are assuming that for every one share, we will have one option. For every one share, we will have one option. We are assuming inherently that the ratio is 1:1. This is which ratio? Can anyone tell me which ratio I'm talking about? How many shares against how many options?
Hedge ratio.
Very good. So this is hedge ratio. So what we have to do? Okay. In the previous questions also, remember the hedge ratio was 0.5. It means 0.5 shares for one option. Correct? This was the meaning. So hedge ratio will give us how many shares to be purchased so as to write one call option. Clear? So for writing one call option, I have to purchase how many shares. Ultimately, that number of shares will get multiplied with the spot price. Correct? So let me again rewrite the premium formula. Premium of call option is equal to spot price multiplied by hedge ratio. Clear? Minus present value of strike price. Correct? Till now we were here. Are you with me, all the students? Hope you understood why we have multiplied the hedge ratio so as to say that for one option, these many shares will need to be purchased. Clear? Yeah. So we are here. Then here also finally we have done one more mistake. What is that mistake? The mistake is we have assumed that the strike price is higher than the spot price. Because you're talking about call option, we have inherently again assumed that the strike price will be, sorry, the strike price is lower than the spot price. I mean, the spot price on expiry will be higher than the strike price. Now, students, please note that this call option will only be exercised if on expiry the spot price will be higher than the strike price. Then only the premium will be calculated, right? So, standing as on today, we need to know that what is the probability that the spot price on expiry will be higher than the strike price of the option. See, let me write. This is the final step, okay? Assumption that option is in the money. Here we have taken this assumption that option is in the money, which is not a right assumption. It can be out of the money also, right? So we have to account for that value as well in the premium. So I'm just rewriting the formula premium of call option, right? I'm just rewriting the formula below. Spot price multiplied by hedge ratio minus present value of strike price multiplied by probability that spot price on expiry is higher than strike price. Only if it is higher, then the premium will get calculated. If it is higher, then it is in the money. Because there is another probability that might happen that it will become out of the money, right? So we have to account for both the possibilities, and hence we are making use of probability here. Now this is the final formula of Black-Scholes model. So this is the final interpretation of Black-Scholes model. I hope all of you understood. So student, why I'm saying that if this is not adjusted, okay, if this is not adjusted, your premium will get calculated same in whatever the actual outcome will be, which we don't want. We want the premium should be linked to whatever the price on expiry becomes. Whether it is higher, then yes, premium should get calculated. If it becomes lower than the strike price, then it should not be calculated. So premium becomes S multiplied by N D1 minus XE minus RT. Sorry, there is some question. Multiplied by ND2. Okay. So if you see, this is the spot price. This is the hedge ratio. This is the present value of strike price. So X is the strike price and e raised to the power minus RT is the present value factor. Okay. ND2 is the probability that we have talked above. Okay. So S here is the spot price. So students, don't get confused between this X and the other multiplication X. Let me use some other value here. I'm using, let's say, E, the exercise price. Okay. So this is for the multiplication sign. So S is equal to spot price. E is equal to exercise price. ND1 is equal to the normal distribution value for D1. And please remember, this will be cumulative. I will come to this, what is normal distribution. Some of you might already know this. Then ND2 is normal distribution value for D2. This is also cumulative. And D1 is equal to natural log of S by E plus R plus volatility square divided by 2 multiplied by time period whole divided by V, which is volatility underscore under root T. And D2 is equal to D1 minus V under root T. And here R is equal to the risk-free rate. T is equal to time to expire. Whatever is the balance time period left for expiry. V is equal to volatility. This is called as standard deviation of returns. Correct? You would have studied this in your portfolio management. S is equal to spot price and E is equal to exercise price. Okay, this natural log, this we have already discussed, right, is actually denoted by this sign, and it is reverse of exponential function, which is E function. So for example, E raised to the power A is equal to B. Correct? If this is the case, then natural log of, so natural log means which has a base as E of B will become A. This is the expression that denotes the reverse, the inverse of, so basically natural log and E, both of them are inverse to each other. Okay, so don't get, I would say don't get stressed after looking this big formula. It's nothing, it's very easy. See, if the Black-Scholes model portion is there, right, it's the easiest one because you have to just put the numbers in the formula and calculate the things. It's a calculation extensive portion, I understand that, but it is very straightforward and easy. So you have to just remember the formula, put the values and move ahead. So let me explain you this normal distribution here, because I think the rest all things are clearly self-explanatory, right? Okay, one more thing before that, which is a easier one. Now, D1 is actually comprised of S by E, right? Natural log of S by E. Correct? So if spot price goes up, this expression will also go up, right? Because S is in the numerator. If this goes up, then D1 will also go up. If this goes up, then premium will also go up, which is true, right? For a call option, if the spot price increases, the premium should also increase, correct? Because the gap between exercise price and premium is getting more. Sorry, the gap between exercise price and spot price is getting more. Spot price is becoming higher, which will eventually lead to higher amount of premium. Similarly, if I talk about some volatility, so if volatility is higher, it should drive the premium also higher, because volatility high means risk is higher. If risk is high, then premium should also be high. So if V is increased, then R plus V square divided by 2 will also increase as a term. If this will increase, then D1 will also increase. If this increases, then finally the premium will also have a increasing impact. Okay, so we are just trying to see what is the impact of different factors that is happening on the respective values. Now let's come to the normal distribution. So students, if you see, normal distribution is a distribution which distributes the values equally from mean, right? So for example, this is actually mean. Let me assume that let's first say that there is a series of data. Okay, in our case, what can be the series of data? The share prices, right? Let's say 10 years historical share prices is the series of data. What is the mean coming out of it? Let's say 10. 10 is the mean coming out of the last 10 years historical data. Now, the standard normal distribution table, what it will do, it will help you to calculate the probability of the future price basis the historical data, and it will distribute the entire data points in the standard manner. So this is mean minus standard deviation. This is mean minus 2 times of standard deviation. Then this will become mean minus 3 times standard deviation. Okay. And here it is equal to mean plus standard deviation, mean plus 2 times of standard deviation, mean plus 3 times of standard deviation, like this. Okay. Now, basis that 10 years data, you have to calculate two things. One is your mean, which is 10, and another one is the standard deviation, which is, let's say, 3. Okay, the way to calculate standard deviation would have already been discussed in your portfolio management, right? How the standard deviation is calculated. It's very easy. So you have to calculate the respective observations deviations with the 10, which is mean, and calculate the standard deviation. Okay. Now it will say that 0.50 and 0.50. So basically this, which is value in between this 10, so left to this is also 0.5, right to this is also zero point 0.5. Okay, that is point number 1. Now point number 2 is, if this is 10, so this will become 10 plus 3, 13. So then 10 plus 2 into 3, which is 16. 10 plus 3 into 3, which is 19. Clear? And here it will become 10 minus 3, which is 7. 10 minus 6, right? 2 into 3 is 6, which is 4. And here it will be 10 minus 9, which is equal to 1. Here, these are the absolute values in below. Okay. And this area under the curve gives probability. Now, for example, you have to calculate for 18, let's say, what is the probability? If tomorrow the price becomes 18, what is the probability of achieving the price as 18? Okay, so for that, we have to calculate the Z score, in which 18 minus mean divided by standard deviation we will do. So the standard formula is A minus mean divided by standard deviation. So here effectively what we are doing is we are doing the mean as 0 and standard deviation as 1. So the standard normal distribution has mean as 0 and standard deviation as 1. Okay, so while we are calculating the Z score, this becomes automatically like this, right? 18 minus 10 divided by 3. So this is 2.66 is the Z score. So 18, I'll tell you. So 18 observation for 10 mean and 3 standard deviation. 18 for a table which has 10 mean and 3 standard deviation is equal to 2.66 for a table where there is 0 mean and 1 standard deviation. I hope this is clear. 1 standard deviation. This is looking like 16. Okay. So this is now comparable, the Z score. Now we will put this value in the table and arrive the area under the curve. Okay, the table, wherever this 2.66 we will put, accordingly we will get the number to say the probability. And if I want to denote it like this, so this whole area up to here, this whole area under the curve up to here will denote the amount what table will say against 2.66, which is the probability. And this is called as cumulative area up to here, which is all left to right. We have done cumulative because another way is to see only this area. Okay, we are not talking about right to left. We are talking about left to right, the cumulative area. Also, the area under curve, this area under the curve, entire area is always 0. Sorry, is always 1. Area under the entire curve is equal to 1. Why? Because 1? Because probability cannot be more than 1. And I'm saying that area under the curve represents probability. Clear? There is one more thing. If we say, let's say 18 was the number that we were trying to calculate the probability, right? So for that 18, let's say the probability is 0.70. So the probability that the number will not be 18 will be 0.3. Correct? So in totality, it will become 1 because again the probability is always 1. Clear? Sometimes the question gives us one tail probability. Okay. One tail probability. Now, one tail probability needs to be always converted to cumulative. Right? So one tail means that only towards the right, what is the number? So this we can convert it, right? If 0.30 is one tail, then cumulative will become 0.70, as I just explained above. Correct? Clear? Sometimes two tail is given, two tail probability is given. For that, we will first divide by 2 to arrive at one tail, and then 1 minus one tail will become cumulative. Okay? You will be able to understand while you will see the question, the way it will be drafted and the way we are supposed to answer that. It will be pretty clear from there. And one more thought, or let's say one more fact. So the u minus 3 times of standard deviation and u plus 3 times of standard deviation, which you will see that is from here till here, right? This and this, we are talking about the first and the last. So around 99.7% of the values are in between these two intervals. Only 0.3% values are here and here. Clear?
So can you reiterate the two-tail portion that you have said just?
Yes, yes, yes. So in case of two tail, what happens? The question is just multiplying one tail into two to arrive at two tail. So what we will do first, converting this two tail to one tail, we will divide the two tail divided by 2. You will arrive at one tail. Now this one tail to cumulative, we will do 1 minus one tail to arrive at cumulative. The way we did above. Okay?
Okay, sir.
So this is the concept on standard normal distribution. See, students, I am saying that we need not be perfect. In the standard normal distribution table, we just need the working knowledge, right? Standard normal distribution table itself is a very big topic, right? And I understand that we would have studied it earlier in the some way or the other, right? So I have just recapped all those understandings, right? And to enable you to solve the question. As far as question is concerned, you will find it relatively very easy because question will give you those specific set of values which are need to be considered for calculating the Black-Scholes model. Okay, so let's see the question first, and then in case there are any other doubts, I am happy to take them up. Okay, start question number 22. So this is the question on Black-Scholes model, students. Okay, we will apply the formula that we have understood and calculate the values. From the following data for certain stock, find the value of a call option. Okay, it is asking us to calculate the value of the call option. Price of stock now is 80 rupees. Exercise price is 75. Okay, the spot price is given, the exercise price is given. Standard deviation of continuously compounded annual return is 0.40. Straight away, they have given you the volatility. Maturity period 6 months, which is time to expire, T. Annual interest rate is 12%. This is also given. Given number of SD from mean. Can't you relate this to what I have discussed? Yes. Number of SD from means what? Z score, right? Which is A minus mean divided by standard deviation. So number of SD means how many numbers of SD are from mean. So what they're saying is Z is equal to 0.25. Then area to the left or right, which is one tail, is this much. Okay. Similarly, for other values also, the area of one tail is given. E raised to the power 0.15 into 0.5 is equal to, this is also given. This we will use in the doing the present value of strike price, right? Natural log is also given. Simple. So everything is given. Whatever is complicated, that is all given. Again, I'm saying either the question will indicate you how to calculate it or it will give you very specifically. Okay. So let's apply everything and calculate the call option value. Value of call option using BSM, Black-Scholes model. Okay. First, let's write the formula. Value of call option is equal to spot price ND1 minus, here I'm using X. I'm not using the X as a multiplication sign. XE minus RT ND2. Clear? This is the formula. Here D1 is equal to natural log of S by X, which is the strike price divided by the exercise price, plus R plus volatility square divided by 2 into T whole divided by V under root T. Clear, students? Natural log of S by X is equal to natural log of spot price is 80 and exercise price is 75. This is given in the question, 80 by 75. Clear? So this will become natural log of 1.0667, which is given in the question 0.0646. Easy. So D1 will become 0.0646 plus R plus V square, right? So R is 0.12 plus volatility square is 0.40 divided by 2 whole multiplied by T. Now students, please don't mistake by doing this R also as equivalent to T first. No, let's not do that, because overall we are multiplying with the term, which is 6 months, right? If you directly take instead of 12 here 6, if you directly take here instead of 12 6, so it will get multiplied 2 times. So you have to always take here what? Annual percentage. Always take annual percentage. This whole divided by 0.40, which is volatility, under root 6 by 12. Clear? So D1 becomes 0.0646 plus 0.12 plus 0.08 multiplied by 0.5, this whole divided by 0.2828, and hence D1 will become 0.1646 divided by 0.2828, which is equal to 0.5820. So that D1 will become 0.5820. And D2 is equal to D1 minus V under root T, right? This is what we discussed. So D2 will be 0.5820 minus V underscore T we have already calculated here, right? 0.2828, which is in the denominator of above formula. So let's use that. Nutshell, it will be equal to 0.2992. Okay. Now we have to calculate ND1 and ND2. So which means N 0.5820 and 0.2992. These are the two values that we have to calculate, correct? Easy, students, till now. Please do let me know. Are all of you able to understand this?
Yes, sir.
Perfect. Yeah. So after calculating D1, D2, we have to calculate the N value for them. N value is the normal distribution table value from left to right, which is the cumulative one. So let's calculate first number of SD from mean, which is the Z value, right? We have been given one tail. Can we calculate the cumulative one? The answer is yes, we can calculate the cumulative value. So for 0.25, we have been given as 0.4013. Yes, 0.4013. Clear? For cumulative, it will be 1 minus 0.4013, which will be equal to 0.5987. The next one will be 0.30. This is 0.3821, which is 1 minus 0.3821, which will be equal to 0.6179. For 0.55, 0.2912 is given. 1 minus 0.2912 will become 0.7088. 0.60 will become 0.2743, which is 1 minus 0.27, sorry, 0.27. So the cumulative value becomes 0.7257. Now students, if you see, we have to calculate 0.5820, and we have been given 0.55 and 0.60. So what we have to do in order to achieve this, we have to actually use the,
Interpolate.
very good, we have to use the interpolation technique. So if 0.55 is equal to 0.7088 and 0.60 is 0.7257, then using interpolation technique. So the n value, which is for 0.5820, right? This value will become the lower value. I'm just using the formula right away, okay? Which is the lower value, and we will take in the numerator the difference between the higher and lower value. 0.7257 minus 0.7088 divided by 0.60 minus 0.55, this whole multiplied by the lower and desired value, which is 0.5820 minus 0.55. So the n, which is 0.5820, will become 0.7197. So this is what exactly, students? This is the hedge ratio. ND1 is the hedge ratio, right? So for every one option, 0.7197 share needs to be purchased. Clear? I hope this is clear, students. Then for ND2, 0.2992 will become 0.5987 plus. So this 0.2992, we will use this interval, students. 0.25 and 0.30. So we'll start with the lower value, which is this 0.5987 plus the interval between these two, higher and lower, multiplied by the interval. I'm just writing here. This is the interval that will get multiplied here. So n 0.2992 will become 0.67, sorry, 6176. This becomes ND2. Now what does this denote, students? Tell me. 61.76% or 0.6176 denotes what? It denotes the probability that spot price on expiry will be higher than strike price. Clear?
Excuse me, sir.
Sorry?
Sir, Jini Oja.
Yes, Sunny, tell me.
Sir, due to some problem, I couldn't attend this lecture for 4 to 5 minutes. At that time, you have explained the 0.7197 value, how it is come. Can you please explain again?
Okay, sure. Let me explain again. So we started from here. For ND1 and ND2, we calculated what is the D1 and D2, right? So D1,
Yes.
D2 calculation is above, that is clear. Now for calculating the ND1 and ND2 value, as I've said earlier, that we have to use the cumulative value, right? Cumulative means from area under left to right. One tail means that only towards the left or only towards the right. So first of all, for whatever four values we were given, we have converted from one tail to cumulative. How we have converted that? We have just taken 1 minus 1 tail will become the cumulative one. Right? For first, second, third, and fourth values, all four values put together.
Okay.
Now we have the cumulative values, right? Against these cumulative values, we have, let's say, we have to calculate the value now 0.5820. This is not specifically given, right?
Yes.
So we have made use of this interval, which is 0.55 and 0.60, because 0.580 will lie in between,
Yes, sir.
right? So we have used the interpolation technique. Now using interpolation technique, the the way it starts it, that you have to first start with the lower value, which is this 0.7088. Then you have to take the difference between higher and lower value in the numerator, which is this.
Yes, sir.
Then you have to take the in denominator the difference between the observation value, which is this 0.60 minus 0.55. And then finally you have to multiply from small value at what value you want to arrive, which is 0.5820 0.5820 minus 0.55, right? So this is the interpolation technique formula, the entire formula. Okay,
Yes.
using this we have calculated the n value basically. Clear, Jenny Oja?
Yes, sir. Clear. Thank you so much, sir.
Okay, so if you solve this, then we will get 0.7197, which is the n 0.5820 value.
Yes, sir. Thank you, sir.
Okay, thank you. Now we have got both ND1 and ND2. Now let's put it in the formula. Spot price was how much in the question? Around 80, and 75 was the strike price. 80 into ND1, which is 7197, minus 75, which is 75 is the strike price, multiplied by e raised to the power minus t. E raised to the power minus t into r. So T will be 6 by 12. Correct? Multiplied by ND2, which is 0.676176. So the value of call option is, this is 57.57 minus 75 divided by e raised to the power 1.2 into 0.5. Why I have done divided by? Because it's a property. If raised to the power is minus, so you can get the entire value in denominator and minus will be removed. Or if something is denominator, you want to multiply above, then you have to put a minus raised to the power. Okay. So this is a simple thing that I have done into 0.6176. Now this value is also given in the question, students. If we see this, where is the e raised to the power 1.062? Multiplied by 0.6176. Clear? So 57.57 minus 75, which is the strike price. The present value factor is get dividing, which is 1.062 multiplied by 0.6176. Hence the value of call option becomes minus 43.62, which is equal to 13.95. Okay, students. I hope the concepts are clear till now. Sorry. Okay. So the Black-Scholes model is clear from call option perspective. Let's take it for put option now. So it's exactly reverse. So we will take case number 4 from yesterday's discussion. Sorry, from the first half discussion, today's first half discussion. Case number 4 we will take, wherein we said we are selling the put option. This is A, and at that same time, since you are selling the put option, what other thing you will do in the equity market? You will have to sell equity share in the spot market, correct? So this will give us the cash outflow to the extent of strike price, right? Because if I'm selling the right to sell, and if the other person exercises that right, then that person will sell it to me and I will have to pay him the strike price equivalent value. Here Since I am selling the equity share today, so the cash inflow will be equal to the spot price. Understood? So this A and B will change here in this manner. Now, some of you might thinking that how can the equity market, the share can be sold without having it, right? So for that we discussed earlier also. So let's say borrow one equity share. This is step number one. Then we will short sale of equity. Step number two. After short selling it, we will invest present value of strike price. Correct? Because we are having a put option also. We are selling a put option. So we might have to pay the strike price equivalent value. So we will invest the present value of strike price, and then on expiry, redeem present value of strike price on maturity. Correct? Then finally what you do? You purchase one equity share under the put option sold. This you are doing under put option, right? So here the put option is also getting executed. And then finally, you give it back to the person from whom you have borrowed that share. Correct? So with this, the both the strategies are there and can be executed. Correct? What are these two strategies? You will sell the put option today and you will also sell the equity share today. Clear? And hence this becomes A minus B. Now from a Ojajini.
Sir, actually, in every question, whenever the selling call option is clear in my mind, but whenever this selling put option is coming now, in every question I will clear, and in new question when it is come, I got confused. As in this
Okay.
question, selling put option gives cash outflow to the extent of strike price. How it is give outflow? That's why I'm getting confused.
Yes, okay, I'll tell you. Here, the selling of put option, what will happen by selling the put option? You will sell the right to sell, right?
Yes.
You are selling right to sell. Now, tomorrow, if the other person who has purchased this right to sell exercises this option,
Yes.
then that person will be selling the equity share to you because I have sold the right to sell, correct?
Yes. Yes.
Hence, I have to purchase it. I have to purchase the equity share because that person is exercising the right to sell and he will sell it to me. Now, the moment I will have to purchase it, I will have to pay the equivalent value of the strike price.
It
So
means
that is why there is a cash flow, yeah, a cash outflow to the extent of strike price.
I will sell my put option to someone,
No,
and
no, no,
he,
no, no. I am not selling put option. No, no, no. Wait, wait. See, sorry, yes, I am selling the put option at the first place, but then later on I am purchasing the share under the put option.
in exchange of this put option, na sir?
No, 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 not in exchange of the put option. See, okay, today Mr. A is selling right to sell. Okay. Selling the right to sell to Mrs. B. Okay.
Yes, sir.
So Miss B becomes the the option holder, and Mr. A becomes option writer, right? Now, and time to expiry is, let's say, 3 months.
Yes, sir.
Now, what will happen after 3 months? If, let's say, the option gets exercised, what will happen after 3 months? Mr. A, who has sold the right to sell, will have to purchase the equity share. Okay, let me also specify right to sell of equity of X Limited. Okay,
Yes,
so after 3 months, what Mr. A and Miss B will do if the option gets executed? So Miss B will sell the equity share under this option, right? And
yes, sir.
Mr. A will purchase the equity share.
This is a position after 3 months.
This is a position after 3 months, right? They have to purchase and sell after 3 months if the option gets executed. I'm saying if the option is in the money. Here we are assuming that the option is in the money, and hence this option will get executed. Once the option will get executed, Miss B will be selling the share because Miss B has purchased the right to sell. So for executing the right to sell, Miss B will sell it to Mr. A, and Mr. A cannot deny Mr. A has to purchase because Mr. A is an option writer. Option
Yes,
is available only with the option holder, not with option writer. Okay,
yes, sir. Yes, sir. Yes, sir.
understood?
Yes, sir. Now understood. Thank you, sir.
So ultimately, if Mr. A has to purchase the share, then Mr. A has to pay cash outflow of strike price, and Miss B will receive the cash of strike price equivalent, right? Whatever
Yes,
it is.
yes, sir. Clear.
Okay.
Thank you, sir.
Yeah. Now let me just write the formula of put option under Black-Scholes model, right? Using this A and B. This A and this B I'm talking about. This A and this B. Okay, this is the case number 4 that we discussed. Selling the put option and simultaneously selling the equity share. So ultimately, X divided by E raised to the power RT. This is the present value of strike price. N minus D2 minus S N minus D1. Now students, if you see, this becomes the cash outflow, right? At the expiry of the option, once the option will get exercised, this is the cash outflow minus, if I sell the share today, this becomes my cash inflow, right? So this is today's cash inflow, this is expiry's cash outflow, but since we have taken present value factor here, it becomes the cash outflow as on today. So both the values will get compared, and the value that we will arrive at will be the premium. Okay. Now, if I may say, ND2. ND2 was what exactly? ND2 was probability that the price
Will go up.
will be higher, yes, than strike price. Now, can anyone tell me what is this N minus D2, which we are using in the put option?
Probability that price will go down.
Very good. Very good. Because we are talking about put option, and put option will become in the money when the price goes down below the strike price. Hence, we are using here the probability that the prices will go the will go down than the strike price. Clear, students? So this is what it is. Put option, this is the formula, very easy again. Here also the process remains same. Whatever nd1, sorry, whatever d1 was there, the same formula remains here for d1. Then while calculating the normal distribution table, we will calculate it for n minus d1. Similarly for d2, whatever formula we studied in call option remains same, but here it's just that while calculating the normal distribution table, we will find it for n minus d2. Okay, so this is the formula of put option. Okay, then if I just take couple of minutes more, let me just recap the entire thing that we have discussed till now in derivatives. So derivative students, in this topic, till now we have studied forwards. Then we have studied futures. Then we have studied options. For all these three, we discussed about the concepts, right? What do they really mean? We discussed about their uses in the hedging part, right? How we can use them, leverage them to hedge. And lastly, we discussed about the valuations technique. So for forwards and futures, it was a regular compounding that we used, correct? And for options, we used binomial model, risk neutral method, and lastly, Black-Scholes model for value of call and value of put option. Okay. So with this, today's session from my end comes to a closure. I request C. Ashish sir to please help with the concluding remarks. Thank you all. Thank you, sir.
Thank you, Devas sir. Am I
Thank
audible?
you. Yes, sir, you're audible.
I think Pooja Jain has raised a hand. Yes.
Hand, yes. Yes, Pooja.
Sir, in the current situation that we were discussing about a put option, here the
Mhm.
N minus one, would it be how many shares to sell now to write a put option?
Yes, yes, that is true. N minus D1 will be that.
Okay, sir.
Okay.
Okay. Any more
Yes.
queries there? Okay, student. With this, we come to the end of this today's session. And in today's session, Devas sir has explained the valuation technique, evaluation of the option techniques. Now, if we talk about this technique, there is, if you overall go through, there is only one major, you can say, basis of option valuation technique is, we can say, hedging portfolio. We can say it is a kind of a hedging portfolio. That is, I am writing a one option, and in lieu of that, how many share I have to hold. And if I am investing today this much of amount, at what rate of risk-free rate of interest, its present value will be, we equalize the same. So this is the only logic. Once you see what happens in it, is of course for this computing this hedging part, how many share I have to hold. In a binomial model, there is no problem at all. But quite for the in a Black-Scholes model, we have to apply one formula. Okay, so that is only the one formula. Otherwise, if you understand the logic, you will not face any problem in this chapter. So I think with this, sir, in the next class, what will topic you shall cover? You will cover?
Sir, put call parity theory,
Yes.
and some of the other derivatives like weather derivatives,
Okay, okay.
electricity
So with
derivatives,
this,
theoretical part.
theoretical, you will come to you will come go through
come
with.
to an end from
Yes.
my side on the next session. Yes, sir.
Yes, then we shall take the real option separately. So, okay, student. So you revise whatever haven't discussed till in today's class. And if you have any query, you can ask me over this telephone, or you can send us the email, or you can send your query at the BS mobile app. So with this, we come to the end of the session. Divas sir, thank you for sparing your precious
Thank you,
time
sir.
and
Thank
enlightening
you, sir. Thank
on
you.
this topic. And student, thank you all for patient listening, and see you in the next class. Thank you. Have a nice day.
Thank you,
Sir,
sir. Thank you, sir.
swap is also part of derivative.
Which beta?
Swap.
Swap. Swap is also the part of derivative, but generally it is covered under the interest rate risk management. Okay. When we
Okay.
shall take the topic of interest rate risk management, there we will cover in the details, because generally what happens, I tell you, swap in generally used in two cases. One is in a currency to has the currency risk, another is to has the interest rate risk. So generally it is covered in the interest rate risk chapter, because generally it is more of a use for the hedging the interest rate. Generally cross currency swaps are there, that is also called circus, but generally it is, of course, the hint is there in the foreign exchange topic there, but properly it is covered under the interest rate risk management.
Okay, sir. Thank you.
Okay, beta. Okay, students, see you in the next class. Thank you. Have a nice.
Thank you.
sir.
Thank you.
Thank you.
Thank you. Yes.